So in the weekly chart, if you see what we were doing here, we had traded up here the previous week, and this is obviously showing what was now last week's trading. So this hadn't formed yet right when we were trading in the close of the previous week. So assuming that we were looking at the market last Sunday at 3 o'clock in the afternoon Eastern time in US. This is what the chart would look like. It would have this wick here, down close candle, long discount wicked candle to up close, large up close candle, smaller up close candle, and then we didn't see this start trading yet, okay, because the market starts trading and opens at 6 p.m. Eastern time. So looking back through this price action, I expect price to go higher. I've indicated this for the entirety of the month of August using the higher time frame. This wick here, we had closed prior to the week we just ended here. Prior week, we closed here, which is above this wick. So if we're going to go back down into some kind of a discount, we can measure this candle's high, that candle's low, and get an approximation of where the midpoint is, or consequent encroachment, because this is a buy side balance, sell side efficiency. But if I have a candle like this that makes part of the swing low, I want to incorporate that wick, and I want to leave some of this down here open. So how far can a retracement go? Well, theoretically, it could go down to this candlestick's high, and that still would be permissible. It's likely, most likely, it's stronger, most bullish. Can I use any more adjectives to describe my thought process here? I want it to stay inside of this wick, not go any lower than the open of that candle. Now, we're trading down into this candlestick with last week's trading. So if we highlight that range here, I'm highlighting the candle's high and the open. So the open of that candlestick and the high, that is the entire range. So I'm treating it like a gap, just like this would be reasonably expected to see it trade back down into it. But we aren't trading with myopic perspectives. We're looking for very specific algorithmic principles that are going to repeat, that have to have some measure of logic behind them. Otherwise, you'll be trying to capture every little fluctuation into an imbalance or inefficiency, thinking it must close there. And that is the difference between what I teach and am actively teaching versus everybody else there that thinks they understand imbalances. So the candlestick's wick here, because we opened up here last week, that makes this wick a discount array because it's below where we opened. So how far can it trade down? It can trade down to this candle's open right here. So the entirety of that wick's range. This opening price is an order block because of everything I just said. It's not just simply because of the down close candle. Everything a part of it. It's a swing low. We closed above. We opened. We're above this wick. This imbalance, it'd be better if what? If it leaves the lower half open. So it can trade down into this wick here and touch the opening price, which it does efficiently, and it does go past this a little bit, but not much. That is a mohawk. It's something that is not perfect, but it's something like your child just coloring outside the lines of the coloring book page. You're not going to reprimand them. You're not going to say, look what you did wrong there. You're going to hang it on your refrigerator. You're going to take it to work with you. I use this analogy all the time. So when the algorithm is repricing just outside the lines that you think would define perfect price delivery, you can't assume that something's broken. That's actually what you want to see. You want to see it made an attempt to get below. And did it accelerate going lower? No. Okay. So with this framework here, we're going to start fleshing out some more information. So here's half of that wick. So that price is 19,440.50. That is consequent encroachment of this wick. Can it trade below that? Yes. But if it does go below it, we need to start seeing some measure of immediate rejection. It needs to show strength. It needs to be able to quickly get out of that area and not lay around in there a lot. Just it can go down below it, but it needs to reject it and start working towards the higher half of that wick, as we see here. So I'm drawing your attention into this. So while, yes, we traded down to the opening of this weekly candle, we hit the order block, we went to the low of this wick when we opened up last Sunday, traded down to it, but now my attention is here inside of this portion of price action, defined by this candlestick's high and the midpoint of this entire wick. So what I'm essentially saying is the bulk of what I intend to do trade-wise is going to be better suited in this blue shaded area. Even if I do get something on a long down here, that's fine, but it doesn't require me to absolutely get something down here. It gives you flexibility, basically. The best trades will be down here, but the more opportunities will be up in this blue shaded area. Okay, it'll make more sense as we drop down. So these are all things that are expected. We want to see how we open up on Sunday. I never know where we're going to open up on Sunday, but that opening defines our new week opening gaps. So are we opening up a higher than where we closed the previous Friday? Or are we opening lower than we would close the previous week's Friday? And that defines our new week opening gap. You don't define your new week opening gap on weekly charts. You don't do it on a daily chart. You do it with a 1 minute chart. Okay, so this wick shaded area here, just keep that in mind. And that blue shaded trend line is that opening price on a opening price for a down close candle on the weekly chart. All right, so now we're into a daily chart. And here, this blue shaded area, that is where I want to be doing the bulk of my trading. If you can trade back down into that weekly order block, which is again defined by that blue line here defining the order block from the weekly chart, it should go down there briefly, not do blocks and blocks and blocks and blocks and blocks of price action like this. It goes down, yes, and comes right back out. That's exactly what you want. So on a higher time frame, that indicates that we potentially may be going higher. And until we start seeing evidence that it's not the case, then we stick to a mindset that's going to go higher. So we look for buy signals preferably. It doesn't mean we can't look for shorts. It just means that the majority of our leverage should be allocated to longs and not to the shorts. So we have a buy side and balance, sell side efficiency here. We'll comment on in a second. But this low here, watch this here. That low is 19,100.50. That low is 19,140.25. That makes up a volume imbalance. Here is our buy side and balance, sell side efficiency. Here, so it's defined by the candle's high, that candle's low. So that makes this a fair value gap, and it's categorized as a buy side imbalance, sell side efficiency. It's buy side imbalance, it's inefficient in sell side until we get this in this candle. And then it's done both up or buy side delivery, which is simply the movement of the price going higher, and then sell side delivery, where price is offered to the downside to a previous imbalance and inefficient level, which is defined by the single candle right here. That is the high of the BISI. This is the low of the BISI. It trades down to it, to the order block. And how far can it go beyond that weekly order block price, Michael? Well, look what the daily chart's offering. You have a volume imbalance right here. The market opens here on Friday, creating a volume imbalance there as well, which we'll comment in a moment. But it opens and trades right back down to the previous close. So this makes this a immediate rebalance and then sends it higher. Notice that the volume imbalance between this candle's close and this candle's open, that volume imbalance is what I'm highlighting there. That volume imbalance between this candlestick's open and this candlestick's close, that's a volume imbalance, okay? Watch what happens when we look at it when the SET is not toggled. So now it's black. So it looks like this. The volume imbalances go away. I've indicated this before. If there's any widening between the candlestick bodies, if I'm toggling back and forth, I'm doing both settings. The volume imbalance disappear by contrast. Now, with it toggled on, again, it's blue, the volume imbalances appear again. I want to be able to see if it looks like this at any time between the two choices. If I ever see a volume imbalance with one toggled on or off, I'm going to elect to use the one that has the volume imbalances. I want to see the separations because that separation is going to highlight an imbalance or inefficiency, and I want to know what they are. Tuesday's candle from last week here, that's what I'm highlighting. I want you to look at the low of that candlestick right there. That low comes in at 19,441.50. Now, I taught that you have to start using old daily lows and old daily highs. You want to look back at the lows and the highs over the last three candles. So if we're going to trade on Friday, as you saw me do, here's Friday. Look back 3 days. Thursday, Wednesday, Tuesday. See what that does? It affords you several days to refer back to old levels. Now, when we're opening here, are we requiring any necessity around the high of the previous? It can be used, yes, but more closely related to the open on this Friday's trading to Tuesday's low. See that? When we were trading here and we closed right here, before we opened up there, this indicates that what level are we looking at? Is it closer to the previous day's low where we settled here or Tuesday's low? So which one's going to be a more of a impactful price event? More likely to trade to, basically. Clearly Tuesday's low. Okay. Now you can have all of the highs and the lows in the last 3 days indicated on your chart, and you'll watch how they gravitate towards them. The reason why these levels are important is because large institutions, banks, they have lots of orders that they intend to trade the market at those highs and lows because there's an enormous pool of liquidity around them. So if you use these levels predominantly in your trades or frame them as your trading model or where it's going to draw to, you're going to have the best of the best type trades. The cream of the crop, the easiest ones that go real quick to these levels, and many times they're going to perform with low resistance liquidity run signatures, meaning that they're going to be very easily traded to. They won't hem and haw. They won't consolidate a lot before they go to the level you're aiming for, because the intended purpose is the algorithm will reprice to these levels because it understands that there's lots of buys and sells around them. It's not the buying and selling pressure that takes them to these levels. It's the fact that there's lots of pending orders below old lows and above old highs. So it doesn't need to know how many orders are resting there. It doesn't understand that. But it does know by its coding to drive into those price points quickly, not just drift down there and bleed down to it. Many times you'll see them accelerate quickly and you'll see large range candles and jump right to the liquidity. So if you have these levels in mind as the basis for where the trading is going to reach to, or your setups are framed around, you're doing exactly as I'm teaching, because I'm trying to teach you to be a low resistance liquidity run trader that targets obvious huge pools of liquidity, and your trades are more likely to see little resistance. All right, so we have the volume imbalance here, open, trade down the previous candlestick's close, that's an immediate rebalance, and we're trading below Tuesday's daily low of this candle at 19,441.5. So just remember this level here, 19,441.5. That's that low right there. So think about what we've done. We have traded down, redelivered all of this inefficiency. So buy side imbalance has been balanced with a delivery of sell side. There's no longer an inefficiency with price not coming back to overlap all of this up close candlestick between this candle's low and that candle's high. It's delivered here. So when it leaves what? This candle's low. We're back above it here. It comes back down just to overlap this volume imbalance between this candlestick's close and this candlestick's open. That blue shaded area is what's the volume imbalance. So it opens this day on Friday, trades down, that's the Judas swing, and then rallies up. So the price here that defines that buy side imbalance, sell side efficiency Notice the high. It's 19,447.50. Tuesday's daily low is below that. So we're focusing primarily on Tuesday's low. Why? Because the daily lows in this instant is the most salient point to be watching with price. And I gave that level to you earlier in the week with this idea in mind. So these levels were in mind before the week started. Everything that's here until Tuesday's low was formed, I was referring to that candlestick's low right there, and that candlestick's high, and that order block level, and that volume imbalance. Because these levels were in play, that means they were in the chart before we started trading on Sunday last week. And then this up close candle here is a bearish order block. It's a propulsion block because we have the highest up close candle here. As soon as we cross below it, the opening price there, that makes this candlestick validation of that bearish order block. The next candle, we open, trade up into this one. So it does not completely close over top of this one, and the bodies don't close on this candle above midpoint of this higher order block. That makes this a propulsion block. So the opening of that candlestick is the bearish order block. So the propulsion block becomes a target. While we're below it here, it's going to reach up into it. And that's one right there. So we also had this wick here that you can break that down in quadrants in addition to, so they're all potential targets. So again, as these individual new daily candlesticks form, you have new PD arrays that you have to incorporate. But starting with a higher time frame, weekly and daily, from the previous week, you have key levels already that are useful. Notice that we're opening in the lower half, okay, the lower half of that larger weekly inefficiency. Remember, I cut the weekly wick and used the upper half of it. That's what that blue shaded box is here. This is all of a weekly wick because it's going up here and going right back down. Half of that wick, the upper half, is what I'm going to be focusing primarily on because there should be a lot of sensitivity on all discount arrays in this blue shaded area. If I'm really right on side, if I do believe we're going to go higher, the best buys that really punch, really deliver off of the discount arrays are going to be in this area here once we get back into it. I afforded the market to go down that far, but it needs to only go down there quickly. 1-2 days, bang, up here we are. Okay. What we're looking at here, we have a 15-minute time frame. Everything that was on that previous daily chart, and go one more time. This volume imbalance, and this volume imbalance, and this larger shaded blue area. Those three reference points, okay, we'll see those here. Here's that larger shaded blue, the smaller volume imbalance, and the lowest volume imbalance is over here. So we're watching price Friday afternoon as it's dipping down here. I'm looking at how price traded below that low here, rallied back above, and we caused ourselves to see a breaker form. But I want to be trading at Tuesday's low or lower. Why? Because this is an old daily low. I can't get back to Thursday's daily low, but going back 3 days, that's Tuesday's low. That's why it's on my chart. So I want to be in there buying that. Let's zoom in a little bit. Same chart, 15-minute time frame. We have several things here I want to take your attention to. When we were dropping down here, look real close. See that wick? Why am I selecting this one here? Because this one went down deeper than the previous one. See this one here? Yes, that's a wick, but this one did more damage. It went lower than this one. So it went a little bit lower into that daily volume imbalance. So when we start going higher, which we see it doing here, I want to see, does price drop back down into that Tuesday's daily low, and does it go lower? Yes. And I'm keying off of that consequent encroachment of this discount wick. Why is this wick a discount wick? Because price is up here, dropping back down into its range. That's what makes this a discount array. Look at the sensitivity of it. Look at how price delivered on Friday's trade, where I got in at. So I want you to be mindful of that. And we're going to walk through this entire thing here. Notice also, when this candlestick started trading right here, From this candle to the left, all of these candles were hiding nothing from you. Nothing was hidden from you. So from this low to this candle's high, we have all of this range to work with. So now imagine you're a rock climber, and this is the sheer rock side that you have to climb up. What handholds could you map out as you climb back up in price? Which reference points here are you going to use and then later also expect to use as a foothold? If you were a rock climber, and we're going to personify price as a rock climber, you, okay? How is price going to use all of these candlesticks here to get back up to a level of significance? A premium price, a higher price. You need not get up to this high. You don't need it. But you can frame out something here using Tuesday's low. What would you use? I'm going to walk you through it now. Typical buy side and balance, sell side efficiency. Framed by this candle's high, this candle's low. We trade down into the consequent encroachment of that wick, and we leave what open? The lower portion. There's an opening left. See that? We want to see that. That is algorithmic. That's the hand at the card table being shown to you, saying, here's my cards. That's what the algorithm's doing right there. That's not buying and selling pressure. Okay, it's the algorithm indicating, saying, we're going to leave this inefficient because it's going to quickly run higher. This down close candle, once we overtook it there, that makes this a bullish order block. The price on that candle here, we open, we trade down to this candle's opening price. The opening price of that down close candle here is 19,466.75. This candle, we open, trade right down to it perfectly to the tick, and then it starts the rally. Friday, August 30th, 2024, that candle, that low matches that opening price, and you see it there. Okay? That is perfect. That's not buying and selling pressure. Okay? So we're seeing price deliver, and then boom, there's an overblock. Respects it, sends price higher. Then we have a fair value gap. Same thing. Do we have that candle's high to that candle's low? Do we have the entire fair value gap closed in? No. Is it indicating that the markets want to go higher? Yes. So now, from here, we have something higher than that we have to work with in this range over here. What is it? Sell side imbalance, buy side inefficiency. But because we're bullish, we're expecting this to be used as an inversion fair value gap. So this is a SIBI that we expect to see become a bullish discount array. So the market's going to trade up into the higher portion of it, trade back down, hit the fair value gap. Do we see price going higher? Yes. And then comes right back down to what? Consequent encroachment defined by that candle's low, that candle's high. What else is existing around consequent encroachment? What's this? The candle that opens and drops down into this fair value gap here and then sends price higher. What is that now? As soon as this candle goes above this opening price, what does this candle trading above it indicate this is? It's a bullish order block. But this drop down into it there is occurring in the upper half of this inefficiency. We want to see strong indications that it wants to repel away from any discount array in this area because it's now becoming an inversion. So we are not looking for or requiring it to get back down the lower half again in here. It's already done that here. If it would have been straight through and came back down to there, that's the same thing I'd expect here. I wouldn't see it come back down here. I wouldn't require that. Huge, huge thing there for your notebook. So we have bearish order block here in this price swing, the opening price. That's the target you're reaching for when you're below it. And the market trades up to it here. Wonderful. Drops back down, gives another opportunity to reaccumulate around that order block there, and then trades up into a premium wick consequent encroachment there, and ultimately up to the daily bearish order block, which is what I indicated when we were in the daily chart. And there we have the delivery. So now we're dropping down to a 5-minute chart. We have a wick here. That's a discount wick when we're here. So when we drop down into that 15-minute fair value gap, let me go back up one more chart. That's this area right here on a 15-minute time frame. That's what this chart is here. We're going to go into that same area here on a 5-minute chart. But look at that wick right there. See how the bodies stop? So yeah, we drop down into that because there's a 15-minute fair value gap, which is why you have to constantly scroll through your time frames. Even if you have a laptop, you have to have these reference points. Because if you don't, you won't be able to see how price is delivering algorithmically and institutional price delivery. It's not as easy as you want it to be, clearly, but it takes time looking at it. But this is the backdrop behind everything else that was being shown on that 15-second chart. Obviously, on the 15-second chart, there's a lot more PD arrays, but I'm watching everything that I've shown here in relationship to this drop down here. All of that buying in that big blue shaded area, this is all part of being part of that larger weekly wick, the upper half of it. And notice how it had real strong sensitivity off of every discount array. Every single thing that would cause the market to go up as I teach it, it used every single one of them. Not one of them failed. And the ones that were there, they many times indicated like it didn't close in that entire fair value gap. That's exactly what you want. That's exactly what you want. It didn't even get down to mean threshold of the order blocks. That's exactly what you want. It's showing every indication that this thing's going to go higher, and it's really being driven hard. So all these targets should be met easily, and we have it. And finally, we have our last chart here, and it is not a 5-minute chart. Check yourself up here. It's 1 minute. Okay, you can see all the delivery here. The immediate rebalance, the daily volume imbalance, we rallied up, the fair value gap, go back through the higher time frames. And then when we drop down into that right there, when I'm buying that, it's occurring between 150 and 210 macro. Look at that beautiful delivery right there. Boom, right at the low. 2 o'clock. Rally. In here, we have an order block. Opening price hits it. That's one that could be utilized. Here. That's one also at the top of the fair value gap, the shaded in green. That's another entry. We have a fair value gap right there. An order block hits it. That could be another entry for you. This is again all in the 1 minute chart. And then we have the order block here that was on a higher time frame chart, and then price rallies up. We trade through the 15-minute fair value gap. We form that. We drop down again. You can see how we leave the lower portion open, and we drop down a little bit in the 250 to 310 macro, and it's just a time when the market will spool and run for liquidity. What is it reaching for? Trailed stop losses below relative equal lows and into an inefficiency fair value gap on a 15-minute time frame. So the market rallies, and 315 to 345, we have the market drop back down into a 15-minute bullish order block, and then we have the order block here, rallies during the market on close macro, which is 345 to 4 o'clock, and then we have the settlement macro, which is the last 10 minutes, which is 350 to 4 o'clock. And there's your macros. It's for the people that want to know what they are in the last hour. That's what they are. Last hour is trading 3 o'clock to 4 o'clock. That's what these are. Okay. And the market starts to spool aggressively. It trades into the premium wick consequent encroachment and then the daily bearish order block, delivering beautifully there. So that's the business. That's the markup. And you want to use everything that I have here and go back through the chart that I was using on the 15-second chart. Use the video at the original regular pace. Watch what I'm annotating on the 15-second chart. Everything that's shown here is in support of that. So I'm working from a higher time frame down to a lower time frame. That's the price delivery continuum theory. Using the order flow from the higher time frames, how everything should support itself. Discount arrays should send price higher. They should be breaking through premium arrays. Premium arrays should not be offering any resistance when you're bullish. Discount arrays should not see their halfway points traded to, ideally. That means bullish order blocks should not even see their mean thresholds be traded to. Fair value gaps or inefficiencies should see the market leave the lower portion of these inefficiencies open. They can close, but as soon as they get down to the lower end of it, they got to immediately reject out of that and come out of it quickly. They cannot be spending a lot of time inside them. That's institutional order flow. That's how you read it. Okay. Everything is happening because of time. Clearly, as you can see here, and price. I'm telling you what the PD arrays are going to be, so that's the price aspect. The time that the market's going to behave a certain way, that's what I'm indicating here. Okay?